The broadcast is now starting. All attendees are in listen-only mode.
Welcome to FinTech University. I'm Rick Levin. I'm the chair of our FinTech and regulation practice. I'm joined by Craig Nazzaro, Brad Rustin, and Kevin Tran, who are leaders of both our FinTech and regulation practice and also our bank reg practice. We're very happy to have you join us today. We're going to be introducing you to FinTech at a high level, and this will be the first in a series of online programs that we will be offering to help people learn about FinTech and to understand that it's not just crypto or blockchain. But when we talk about FinTech, there's some phrases that catch my mind. The first one is rat poison. Second one is bigger than the internet. Third one is techno tour de force. Now, when we talk about FinTech, Jamie Dimon knows FinTech, and he famously said he's scared, and I'm not going to say the word, of FinTech. Charlie Munger, Warren Buffett's business partner at Berkshire Hathaway, called Bitcoin rat poison. Other people in the industry, Goldman Sachs, said that parts of FinTech known as blockchain could be bigger than the internet. And some small-time entrepreneur, Bill Gates, said that blockchain could be a techno tour de force that could change everything. So when we talk about FinTech, we're talking about a broad category of technologies that cover traditional banking, payment processing, robotic investment advice, trading of securities, and trading of derivatives. But Kevin, if you could go back to the last slide for me. When we talk about FinTech, Jamie Dimon, who basically indicated to his staff at JP Morgan Chase, which is a massive financial services firms, that he's frightened of FinTech. And others in the industry have also said similar things. Now, why are they worried about FinTech? Well, in part, they're worried about FinTech because companies like Amazon and Apple and Google and Facebook are moving into the financial services industry. And through this presentation, we're going to show you the intersection of financial services firms and technology firms and how the lines have been blurring. Next slide, please. So when we talk about the rise of FinTech, we have to remember that recently firms like Square, the online payment processor that you see people swiping at coffee shops, had a capitalization of over $70 billion, roughly the same as Goldman Sachs, which is over a 150-year-old investment bank. We have people like PayPal, the payment processor, that their market cap surpassed Bank of America. And then we see people like Facebook and others moving into payment processing and banking. Next slide, please. So I love this image because people think FinTech is something new. And what I love, being a baby of 1970, is that the Nasdaq stock market started as a FinTech company in 1971. The technology was built by a corporation called Bunker Ramo. And this looks like something out of the movie War Games, or possibly 1960s nuclear war dramas, where this gentleman is sitting at a very sophisticated computer terminal with a green screen with a bunch of tape-to-tape computer systems. And I love the very sci-fi letters of the NASDAQ in 1971 in the background. Next slide, please. So NASDAQ celebrated its 50th anniversary. And people forget that the technology evolved over time to what we imagine as the NASDAQ market of today. But originally, NASDAQ was just a quotation system. It was a mechanism built by what used to be known as the North American National Association of Securities Dealers, now known as FINRA, F-I-N-R-A. And it was built as a means for dealers to interact with each other and to receive information about stocks that were traded in the over-the-counter market. Next slide, please. So I'm going to turn it over to Brad, who's going to walk you through the history of online banking, because as there's been an evolution of electronic trading, there's also been a similar evolution in online banking.
Thanks so much, Rick. And to kind of cue off on what you were saying a moment ago, if we think about the evolution of FinTech and how it's evolved out of traditional financial services, it's a fairly recent development. Now, granted, you had some early precursors of what we consider modern online banking, or what we would call now FinTech, as early as the 1980s, with some banks initially creating ways for individuals to bank by phone or bank by internet. but it's really not until the late 90s that you see widespread adoption of online banking, mobile banking, ultimately in the 2000s. And that's evolved now to the point in terms of the growth of these institutions that this online banking has now become entire banks focused upon it, entire banks that are built as a mobile app, or entire banks that deliver their products digitally as opposed to using a branch structure. And so by 2009, you had a number of banks that were working solely in the internet space, solely providing a digital banking experience to their customers. And every time we look at new survey data, every time new data comes out, we see the growth in online and mobile adoption. And one of the things you're going to hear today as we kind of work through this is FinTech is not just a single animal. If we think about it, the initial concepts were taking traditional institutions, whether that's a securities platform or a payments platform or a lending platform, and adapting it to a digital environment. Now you have digital serving as a leader in a lot of the developments within the financial services space. And so you've seen a full cycle of evolution where FinTech is really driving a lot of the innovation in financial services. Kevin, can you pop to the next slide? And before we do, twice today, you'll be getting code words that you'll have to put in for CLE credit. And so our first one today is going to be Jamie Dimon, D-I-M-O-N. Waiting to see how many people put diamond in their response, but the first code word is diamond, D-I-M-O-N. When we think about FinTech, though, it really is not just a single animal. In essence, every type of financial services product, whether it's something offered by industry, something offered by a financial services company, or something offered by a technology company, implicates FinTech. And this is just a broad sampling of it. But you have everything from what we would call traditional tech focuses, like using artificial intelligence, underwriting algorithms, et cetera, that we see in things like IBM Watson and others, all the way to automated securities trading platforms and high volume trading. And everything in between, digital lending, now automated lending with automated underwriting. We see what are called challenger banks, which are non-banks that are now providing a whole suite of financial services. I was given a presentation last week to a group of bankers, and in essence, what the point was is we saw in the early 2000s to late 2000s a focus on FinTechs doing something well. They would pick a niche and they would blow it out. They would be the best payments company, the best lending company, the best securities platform. And what we see now is just like banks started with a niche and are now going horizontal, so too are FinTechs. And you see now an entire suite of services with deposits, loans, payments, securities, digital assets, and crypto assets, all in one platform, so that you create a life cycle around those customers. And all of that is coming together to really spur the growth of the FinTech marketplace. Let's pop to the next slide, Kevin. And it really is dynamic. If nothing, else, got to find some benefit of COVID, I guess, because it pretty much ruined most of our 2020s and 2021s. But if anything, it accelerated digital adoption. We've seen huge shifts in the number of folks who are using FinTech-based ecosystems as opposed to traditional forms of financial services. And likely the pandemic accelerated that adoption by 10 or 15 years by most estimates as people have been calculating that. But it really is a dynamic segment of industry. You have these well-established technology firms, Apple, Google, other big behemoths in the technology space that are looking at capturing additional market share. But then you also have traditional financial services firms, traditional non-bank lenders, traditional payments companies, traditional banks, a lot of which we'll talk about today, that are all going to shift their focus to this type of digital delivery, digital first. To keep picking on Jamie Dimon, he was famous at JP Morgan Chase for saying that their motto to their staff was mobile first, digital everything. Every single product inside of Chase is being digitized, and they're moving to a mobile delivery platform. Doesn't mean they're killing off branches, but they're aware that that's where the industry's going. And you see the same when we talk about investments. I mean, in a recent PwC survey, 29% of the people who responded said R&D and innovation is one of the top 3 investment priorities of those institutions. huge amounts of money are being spent to gain that market share, gain that penetration, and in essence, gain the stickiness of your customer base by offering a broader suite of financial technology services. You see people, large banks doing fintech labs, incubators, investing in fintechs, partnering with fintechs, and a lot of that's what we're going to be covering today. So Kevin, can we go to the next slide? When you look at incumbents in the fintech space, you see some of the biggest names in banking, institutions that have been around 100+ years that are playing in the fintech space, whether that's digital account opening, whether that's adding products that are consumer facing or maybe commercial facing digital offerings, all the way to a lot of these banks are investing heavily in fintech, incubating software platforms, incubating technology that allows different players in the space to talk to one another. And you see them even going so far as having incubators. At the same time, you also see the large exchanges and clearinghouses. They're focusing on fintech and continuing to invest in it because I think they truly realize that the next 20 years is going to see a focus on the digital delivery of financial services. Kevin, can we go to the next one? When we think about fintech, as Rick mentioned, I think it's great to point home or drive home this point, is it's not just a single class. Instead, take any industry that you're focused upon, and there is likely a fintech component to it. We have things like traditional payments and transaction processors. Some of the earliest folks to adopt a technology-based strategy with the early both ATM and card networks, as well as the ACH software-based clearing systems. Those have now evolved, and you have all sorts of point of sale technologies, you have digital wallets, all evolving out of these very core concepts that two different banks, two different institutions have to have the ability to talk to one another. I can even remember as a child going in and you used to have Fedwire. It was on one of the black screen with the green background IBM 486 computers. And amazingly, it was never hacked because it wasn't hooked to the internet. It just used a modem that connected to the Fed. But that's where you see the precursor of what would become modern payment technology systems, is it's simply a link between multiple players. You then see the rise, as we've been talking about digital banking and bank tech. Certainly the biggest focus of the last 10 years has been alternative lending, as you see massive online lending platforms that are both brokering to banks and making their own loans coming on board, where most people don't go to a bank anymore to get a loan. They're going to go online, or they're going to shop and then get a loan at the point of sale. And so we've seen a huge focus on what we're calling ALSs, or alternative lending systems. You've also seen a lot of growth in wealth and capital markets tech. If you think back to that slide we're looking at, you had the company Mint that in the early 2000s developed a way to scrape data out of other financial institutions. And from that, you have what is now become modern bank-to-bank interfaces, where a single institution can look at multiple accounts and help you with investment advisory services, broker-dealer services, wealth management, trust work, all through digital channels that don't require in-person participation. But it also extends to other areas like InsurTech, the ability to use big data and technology as well as financial systems to better deliver insurance services. Same thing with healthcare. Some of our largest payments clients are in the healthcare payment space because you have large volumes of money moving back and forth, and you're really looking for those technology solutions that can make it simpler, frictionless, less returns, less NSFs. Same thing with financial management. These are your pure plays like Mint and other wealth management platforms, where you're really trying to see folks, as I say, go horizontal. How do you get from a traditional vertical, I did payments well, to now expanding out and getting more market share from those customers you spent so much money and time acquiring? And then similarly with financial BPO and IT services, all of the infrastructure and technology that's really back-ending and making all of these solutions possible, whether that's accounting, finance, staffing. Some of the biggest innovations have been through ways to automate and centralize for small businesses and medium businesses all of their various financial transactions in one platform. And so we see huge growth in that field as well. Kevin, can we go to the next one? When we think about it, this is the FinTech 250 that CB Insights publishes that takes a snapshot of kind of the world of FinTech and tries to classify it into different categories. And if you look at all of these different areas, it's touching on a huge portion of industry within the United States. You know, everything from consumer lending, business lending, payments, core infrastructures, all become part of this FinTech ecosystem. And certainly as we think about it as a practice, FinTech is not a silo. FinTech is a solution for many of the practices inside of our firm, whether it's the automotive practice or the insurance and healthcare practice. It's a solution that gets deployed and is probably where a lot of the focus is going to be in the next 20 years. You have the next one, Kevin? You know, what you see too is a lot of these incumbents we've been talking about are trying to pivot and shift. You know, if you think back to that slide we showed with the history of banks that, you know, got into online banking, you know, early in the cycle, by the mid-2000s, Bank of America had almost 20% of its customer base operating through an online channel. And that's pre really the massive rise of cell phones. You know, that's still when you have the Motorola StarTAC that flips open and you could text your friends. But already 20% of their business has shifted to an online delivery portal. That's come full cycle, and now you see, if you've been following it, things such as Markets that Goldman Sachs launched, a pure digital play from one of the nation's oldest banks. I think Goldman Sachs has been around 150 plus years. It's one of the 50 largest banks in the United States. They recognize the importance and the value of a digital play and significantly shifted resources and infrastructure into that program so that they would then have the resources to use in order to continue to grow. Because customers want personalized experiences. You know, it's not at all that unique from the branch model inside of banking. It's the same idea. People want customer service, they want easy, and they want access to different products. And what we're doing is we're using technology now to provide those services that a loan officer or a deposit officer or a customer service representative would have provided historically. But it's not going back to the 80s with 800 numbers that you wait 15 minutes to speak to somebody. It's now. You know, it's somewhat scary. I was joking with Rick one day that I can go into a single app, I can buy some cryptocurrency, I can then transfer it overseas through an international remittance, I can then take out a loan, get a mortgage for my house, and get a high yield savings account all in one mobile app in the space of about 30 minutes. It's become that efficient, and it's become that customized. And so the whole idea is then that customer is not going to leave, is not going to go elsewhere because they have those solutions there. And what we see is people who aren't adapting to FinTech, these incumbents that aren't moving forward, are tending to be left behind, meaning more and more they're being picked off because it's so easy when you're checking out at an online retailer to click make 4 payments and you're instantly approved for a 4 installment loan. Or you're instantly approved for financing for that product. Why would you go and take out a loan for that? Why would you apply for a credit card? It's just there, you click the button and you're good. And so we see that type of change and drive. Kevin, I guess the next slide, please. You know, a few of when we're talking about funding, you're seeing, as Rick really pointed out in one of those early slides, huge valuations now for FinTech. You already have payments companies that are larger than all but the largest banks in the U.S. You know, we were watching the Robinhood IPO. Opened at $38. It's, you know, trading, I think, at about a 20% premium less than a week later. I mean, there's huge interest in this from a growth standpoint. Some of the largest IPOs that have come out, as well as some of the largest funding rounds that we've seen, are all focused on digital technology. And so here's some of the biggest that we've compiled here. And, you know, one of the things that I think Rick does a good job of pointing out is it's not just US. FinTech is tearing down borders. You know, at any one time, our practice is working with companies all over the world. It gets kind of crazy from a time zone standpoint, trying to schedule calls 12 hours offset of Eastern time. But nonetheless, you know, it's very much a borderless world once you're in the FinTech space. Now, regulations aren't that way. It still makes it very difficult. But you see here, you know, Sweden, Brazil, Singapore, Hong Kong, Malta, many countries are now beginning to become big players in the FinTech space as they incubate companies that are developing a worldwide presence and then tapping into large markets in digital heavy countries. it's interesting, even some of the least developed countries in terms of GDP and growth are some of the most advanced fintech. We constantly talk about in the payment space, some of the least from a GDP standpoint developed countries are some of those with the highest adoption of mobile payments and instant payments technology, because it's so valuable there, and they didn't have the long, these legacy platforms, credit cards, ACH, and what have you. Kevin, next slide. And then the last thing I'll kind of cover off is if you think about this next evolution, we've seen what's called challenger banks arise, this switch over to a different model of delivery. Instead of traditional banks, you're seeing this assembly by fintech of what used to be different components of a bank into one delivery platform. So that then, you have a solution that offers what a bank traditionally would, but it's no longer doing it through the charter. And so you see any number of them here as they've grown. I mean, some of the biggest names now in personal banking, Chime, SoFi, Bank Mobile, Moneyline, others that are developing huge market share and have now assembled enough, the fin part of fintech that they're effectively an alternative to a traditional bank. Kevin, next slide. And at this point, I'm going to pass it over to Craig Nazzaro, who's going to go from here.
Thanks, Brad. I think one of the themes of today's presentation is how diverse fintech is, and it's not just banking, or it's not just payments, or it's not just cryptocurrency. And that theme is well reflected when we look at challenger banks. As Brad was saying, challenger banks are newer banks built with the latest technology, normally focused on customer and user experience. Like Brad was saying earlier, they had attacked individual product segments or individual products, trying to either disrupt that delivery or disrupt the product model. And they're also commonly called neobanks or digital banks. Most are partnering with traditional depositories or back-ending onto their systems or their core systems here in the US, but many others are attempting to become chartered themselves. The OCC FinTech Charter, initially proposed by the OCC in December of 16, would have permitted non-depository FinTech companies to operate under a federal charter overseen by the OCC. That was received heavy pushback from the state regulators and is now marred in litigation. But you start to see how the federal regulator was trying to get a pathway for these challenger banks and neobanks to compete on a level playing field with the depositories. Or we saw Square in March 2020 became the first U.S. fintech company to receive a conditional approval from the FDIC for an industrial loan company license coming into Utah. So it's interesting to see them they're continuing to knock on the door of traditional depositories and the door of traditional banking here in the U.S. And here we see, how they're rising not only in the U.S. but also across the borders. As Brad was saying, it's starting to knock down borders as well as, product development. And to Brad's point of, that it produces regulatory challenges, I think that's where we are in the cycle in this development. The regulatory challenges that are out there are being attacked by our clients. Our clients are coming to us, as Brad was saying, from Australia, from Asia, looking to build out in the U.S. to compete on a global scale, not just with the U.S. Focused depositories, but the global mega banks. Which is why, as we open this presentation, we start to mention how Chase is digitizing everything, and Chase is looking towards these products and developments because they are aware that this is how this is all trending in this space. Next slide, Kevin. This is real quick. We just wanted to touch on the funding that you start to see out there for various challenger banks. You get almost up to $1 billion for Nubank. Chime was really well funded for $800 million, and all the way down. They need this funding because they're building from scratch and not expanding into products. They're literally rethinking the way these products are delivered here in the U.S. and across the globe. But it takes a lot of effort and a lot of capital. Next slide, Kevin. Here we wanted to go over the challenger bank value proposition. So we've touched on it a little bit earlier, but they tend to be mobile centric. They tend to present a superior customer experience and integration across your various devices, whether it's mobile, desktop, and app. they're all low fee or no fee, or most of them are, and they're built like tech companies. Well, they are tech companies, so they're very nimble. They're very they can pivot with the customer desires. They can follow market trends, and they're very easy to use. They're very well marketed towards younger generation that could be mission driven, or banking with a purpose. So they are presenting an extremely real threat to traditional banking here in the U.S. Next slide, Kevin. And here's some of those differentiators that we're talking about. So some are divided by market segments, whether it be middle class, you see with Stash, or traveling that you see with Travelers for Revolut. Revolut's an interesting one because it's literally marketed towards the traveler that's going to cross borders frequently. No international money transfers, no fee global spending, exchange, really easy interbank exchange rates. And that's part of their go-to-market strategy, like how the banking is not only specific to a country, but it's now more global in nature. So you can have your Revolut card anywhere you want to go. You can load funds onto your Revolut card from any country that you're currently in. You see others such as broken up by age group, or focusing on developing your financial health. You see another market segment there, PMF, or personal financial management, which refers to apps that help people manage their money, or like Robinhood. Robinhood's whole market strategy, go-to-market strategy, is building your own wealth. There's more that are focused on PMF, but that's one thing that's out there. And then you see some that are tied directly to causes. They might be environmental, or it might be mission-driven. But you're starting to see those entities pop up and gain a significant amount of market share. Next slide, Kevin. And as Brad touched on earlier, these entities started by attacking individual products and perfecting the product's delivery and the product's customer experience or user experience, and then trying to gain market share that way. When that started to occur, like in 2010, 2011, they were starting to slowly grow. Now we're seeing in 2020, 2021, that they're becoming really well represented, and they've successfully disrupted the product delivery across all of these products. Checking and savings accounts, investment products, installment loans, small dollar lending, student loans, credit cards. They're taking that base away from traditional depositories, and they are much better at marketing their services to a different generation and a different user base. Whereas the traditional depositories and traditional banks in the US have had problems capturing that market share, or always looked at things as, this is the way it's always been done. They've lost a significant amount of market share in all these product lines because of the challenger banks' nimble approach, and because they're able to pivot and disrupt these product deliveries. Next slide, Kevin. And here we wanted to express how banking services are being broken down even further as we start to see the proliferation of challenger banks. We're also seeing the individual services be really well represented by the vendors, and the vendors looking to, deploy the product directly to the customer base. So we see, banks at the top there. We see large scale solution, or bank in a box, where we just help existing depositories, or the fintechs help existing depositories, private label or white label every kind of service that's out there, and adopt the various technology solutions that are now available. And if you're in this space and you're not kind of going down that direction, you're going to face a significant uphill battle, as we move along here time-wise, because these entities are out there and they're making it much easier. They're streamlining operational costs because of their tech-heavy approach. It's no longer throwing bodies at a problem or a product. It's now, how can we utilize or leverage our technology in ways that can solve human capital issues or regulatory and compliance issues. We also see vendors that are out there just for account aggregation services. Card issue processors, core bank processors, co-brand and private label card systems. You no longer, if you're in a depository or in a traditional bank, you no longer have to look at a product deployment or a product development as something that's going to be as capital and labor intensive as it once was if you rely on these fintechs that are out there. And if you're not in the banking systems, you can rely on these vendors, or rely on these challenger banks that are out there to provide these services that for your clients that you wouldn't necessarily think are services that a non-banking entity would provide. We see that a lot in our group here, where we start to see companies turn to us for payment solutions, or private label card, prepaid card solutions, or small dollar lending for their own customer base. Depending on the scale of your client, they might want to look to partner with somebody, or they might want to bring it in-house and build it alongside one of these fintechs or alongside one of these challenger banks by taking advantage of those private label and white label solutions. Next slide, Kevin. And here we want to say, like, as we're saying, these are built like tech companies. Some of them are tech companies. We see various entities out there in the marketplace starting to, take market share away from not only the traditional banks or the traditional depositories, but also the challenger banks. You start to see rewards cards or private label cards or payment systems, buy now, pay later opportunities being offered by companies like Amazon, or entities like Amazon Cash or Coinstar there. Like they're starting to do more and more product deployment and more uses for the individual customers as they are seen in the marketplace more and more. Next slide, Kevin. And here we just want, again, touching on that same idea that, FinTech is out there not only for the challenger banks, but also other FinTech players like Apple, announcing a partnership with Goldman Sachs to offer the Apple Card. That is a big step towards, moving away from the traditional banking system here in the U.S. and one, traditional Apple products having its own card, not only used as a private label card like a Disney card, but also used to, defer payment on their own products. You're seeing that disruption in various silos and various markets within the U.S.
And Craig, one thing I think that's kind of interesting is if you look at folks like Amazon that offered a small business lending solution, you have huge quantities of data that a traditional financial institution may not have access to based on the technology solutions. So if you're underwriting a small business loan, you could have the entire life cycle, payment flow, number of people who are looking at advertisements, number of people who are buying a given product, all for underwriting that small business loan, and data that simply couldn't be touched by a traditional financial institution. And so, you've got these big data firms that are now finding much more efficient ways to provide financial services.
Agreed. We'll be touching on this in a more deeper way in coming versions of these presentations, but they're also able to use that data for underwriting, or the ability to repay. You start to see those things being deployed within entities that have nothing to do with banking traditionally, but they're able to have a stronger confidence in their risk profiles because they know their customers so well. And I think next slide, I think we'll switch over to you, Kevin. Am I correct? Yeah.
Yes. And before we go on, wanted to let everyone know the second code word for the CLE is rat poison. We thought that would be appropriate, given the talk today. But now we're just going to switch gears inevitably to talking about blockchain technology. Everyone is certainly well aware of crypto assets and digital assets, your Bitcoins, your Ethereums. Those have started to take root in popular culture. But underpinning all of those assets is really something called blockchain. And at the end of the day, blockchain is essentially a software tool that is really a system for recording information. And it's designed to record information in a way that makes it difficult or pretty impossible to change, hack, or really cheat the system. And blockchain, it's something called a type of distributed ledger technology in which transactions are recorded with a cryptographic signature that can't be hacked again. And this technology, even though again it's popularized by all of the crypto assets and digital assets that have been built off of the blockchain technology, because it is a system for recording information, its application again is much more broad than just for financial instruments and the provision of financial services. What it can be used for example, in the shipping industries, is to handle supply chain logistics. There's technologies being developed in the healthcare space for not only healthcare payments, but also electronic medical records. And so there is a broad spectrum of use when it comes to blockchain, which again, we will speak more in subsequent talks. But you know, before diving into the crypto assets, we just wanted to take note that blockchain can be very pervasive across all industries. So when we talk about digital assets, both the Bitcoin and Ethereum and your more exotic assets, it's hard not to start with Coinbase, which is the very popular cryptocurrency exchange that recently went public and has an enormous market cap. For some folks have joked that if you don't want exposure to a specific crypto coin due to risk, buying into Coinbase effectively could have functioned as an exposure to the entire crypto market. And why Coinbase matters is that it's the first crypto market to go public, and it right now, I believe, is the most widely used exchange. And at the end of the first day of its IPO, its market cap exceeded 100 billion. And granted, much of that price has fallen in concert with the declining prices in Bitcoin and Ethereum. And so there's certainly been questions as to, you know, where these assets are moving and whether they're going to remain popular. But given the volatility of it, and this has happened before with Bitcoin in recent years dropping well below the 60,000 mark that it was at peak earlier this year. And at the end of the day, you're also going to see a lot of legislators and regulators trying to figure out what is the best way to think about and regulate a lot of the digital assets. And not only do you have Coinbase as a big player in it, again, you have a tech company like Facebook, which functioned largely as a social networking site. And if you recall, back in 2019, they were contemplating issuing Libra, essentially entering the cryptocurrency market by creating a native currency for Facebook. And that brought the ire of regulators quite immediately. And regulators like the Fed shut that down largely out of surprise, but also we suspect that there was concerns that there was going to be, it could undermine just currency given Facebook's popularity. So Facebook stopped development on Libra and recently re-entered the space with the reintroduction of Libra, now known as Diem, and they were working with the Swiss regulators to get licensed as a payments network. And recently they decided to pivot and move all of their operations into the United States and essentially work within the confines of US regulation in order to get their payment network approved and up and running. And that still is currently ongoing. And again, back to popular culture and how Bitcoin has permeated all aspects of financial services, that you're starting to see very traditional institutions like BlackRock that are talking about their own investments in Bitcoin and how other banks are more traditional banks and custody banks like Boney that are talking about custodying digital assets and Bitcoin specifically, which is a far cry from what was being discussed with Bitcoin, particularly with your more traditional institutions that of even 5 years ago. And after we've talking about all of the challenger banks and all of the innovation and all of the technologies that are being pushed and are very cutting edge in the private sector. It's important to remind everyone that all of this development and innovation happening in the private sector isn't happening in a vacuum. As much as it might seem like the wild, wild west, and as much as you hear criticisms from Congress about how crypto, digital assets, certain financial fintech innovations are posing a threat to consumers and even the financial system, it's not like the regulators aren't aware and working to wrap their heads around what fintech entails, given how broad it's applied and how broadly the definition is applied. And it's even more challenging because what you often come across as a regulator is trying to fit a square peg into a round hole, simply because we don't have a separate legal regime that deals specifically with digital assets or with a lot of the innovation that the fintechs are pushing at a breakneck speed. What you're getting is a lot of rules, a lot of regulations, a lot of cases that were developed as far back as the 30s and the 40s that are being applied still today. And notwithstanding what Congress is working on, what you're starting to see at the regulators, especially the bank regulators like the OCC, the FDIC and the Fed, and the market regulators like the SEC and the CFTC, they're establishing very robust and strong divisions devoted specifically to understanding fintech, at least within the provision of financial services. And what the big buzzword that you're hearing among all of these regulators is responsible innovation. And I think it's important to understand responsible innovation, because what that really means is regulators aren't necessarily averse to blockchain and all of this innovation, but at the end of the day, their roles are to protect the investor / consumer and to protect the financial system. So everything that they do when evaluating all of this innovation has to be within the context of this responsible innovation. I mean, it's not uncommon to hear from fintechs, including many of our clients, saying, the regulators don't understand this, the regulators are out to get us, they're inhibiting all of this innovation. And we have to remind them that these regulators operate on a very macroeconomic scale and have to really understand and wrap their head around what all is going on, because their rules affect everyone whenever they're issued. So what you started to see is, for example, back in 2017, the OCC started the Office of Innovation. And what that office was designed to do was, for all of the nationally chartered banks, give essentially those banks a venue to discuss financial innovation and to see if, and to gauge the temperature of the OCC. And in short order, you had the Fed start in 2019 to stand up what they've coined their innovation policy team, which essentially amounts to a think tank, an internal think tank where staff at the Fed would work together to develop white papers that would, with the intent of informing policy, with the eventual goal of turning that policy into innovation. Because what, as Brad and Craig and Rick have indicated throughout this presentation, is that fintechs and banks have moved largely away from essentially trying to kill one another and recognizing that the only path forward is through collaboration. So to the extent that you're seeing that banks traditional banks, that is, regulated banks, performing a lot of the back-end services, it's incumbent upon the regulators to really understand how these technologies are impacting the financial system. So the Fed started up their innovation policy team, and meanwhile, the FDIC had the FDI tech team, which that was started, I believe, in 2019 or 2020. And what you see there at the FDIC is a team of regulators and technologists really trying to, again, spur innovation and to do so responsibly. What they've done, for example, is reporting has long been a, you know, just a huge cost center for banks. So they started tech sprints, inviting companies to essentially race to develop technologies that could streamline reporting for banks. And a lot of these tech sprints, because they're hosted by the FDIC gets to observe and see the development of these technologies, and in turn, you know, help to shape it and ultimately help to shape responsible innovation, if you will. And from the market regulators' perspective, you also have the SEC standing up their FinHub, which has been great for our clients, especially our clients who are working in the digital asset space, and whether they're developing trading platforms or working directly with a digital asset. It's been an incredible opportunity for us to help put our clients, even if on an anonymized basis, in front of the SEC, and again, just get a gut check as to whether or not the SEC thinks that a proposed business line or a model would be in violation of any securities laws. And you know, you have the same thing being done at the CFTC. And not obviously not to be forgotten, you also have the second layer of regulation at the state level, where, you know, state securities regulators and even state banking regulators, especially with respect to regulating money transmission. What you see there are states getting into the game of trying to better wrap their heads around all of this innovation, because much like the market regulators, the states want to protect investors that reside in their respective states. And in order to do that, they need a better understanding of all of this technology that is now available to their residents. And what you've seen as an outgrowth, especially at least at the state level, are something called or sandboxes. The CFPB, or the Consumer Financial Protection Bureau, as one of their missions to promote innovation, competition, and consumer access, essentially have started or popularized a program known as sandboxes, where essentially companies can obtain a safe harbor for maybe 1, 2, or 3 years to test their products and services within that time frame, without being subject to rigorous regulations. In exchange, they're going to be sharing data with the Bureau and with state regulators. So again, it's a very interesting program, and something that I think we would like to see further develop, simply because not only does it give companies the opportunity to operate outside, operate without violating laws, to just really test and test their product and see if there's any value to it, but it also gives regulators the opportunity to see a lot of this development happen in lockstep, such that, again, they're getting to see and experience a lot of this innovation firsthand. So when it comes time to actually develop regulation, that they are in a position to do so. And I'll turn it back over to Rick and to talk about FinTech and financial inclusion.
Rick, I think you might be on mute still.
There we go. Thank you, Brad, Craig, and Kevin. This last slide is something that we just wanted to point out that is something near and dear to the entire FinTech team and to our firm. I spoke at a conference a number of years ago in Singapore, and we had people from the International Monetary Fund, we had the Singapore Monetary Authority, we had the head of Citibank Payment Asia. And it was at the time that new Samsung phone was exploding, and I was flirting with getting a new one before it started to explode. And on the panel, I remember I was the doubting Thomas with respect to FinTech and financial inclusion. And I remember asking the head of Citibank Payment Asia, is a ATM more secure than a smartphone? And without flinching, God bless her, she said, the smartphone is far superior to any of our ATMs. And I pulled out a credit card and said, well, what about this credit card? And she said, nope, that's a 70-year-old technology. And I pulled out another credit card with a chip, and she said, that's a 50-year-old technology. And I said, well, why is the phone so much better? And she said, because it has built-in facial recognition, built-in thumbprint recognition, and encryption. And then she said the magic words, we, Citibank, believe that over the next 20 years, more people will get access to a smartphone than to our branches or ATMs. At that point, I became a convert to the cause of FinTech and inclusion. And what people don't realize, around the world and in the United States, there are large swaths of the population that do not have access to economical banking and investment advice and the ability to save and retire and to transfer money to family that may be living in foreign countries. And FinTech and smartphones and the technology of the internet have now made it possible to bring banking to the underserved banking community or the unbanked at more economical price. One thing that has always bothered me is that the wealthiest people in the world pay the least for banking and the poorest people in the world pay the most for banking. Well, we believe that FinTech and financial inclusion is the path to bringing banking to the unbanked or underbanked. And we're very committed to this. But before we turn to questions, just in conclusion, we will be doing follow-on presentations that will go deeper into challenger banks, into technologies like blockchain and distributed ledger and digital assets, into the applications of FinTech in other industries, be it automotive or healthcare or energy. But I want to remind everybody that today during this presentation, we're not talking about crypto. We're talking about some of the biggest banks in the world and biggest technology firms in the world, JP Morgan, Chase, Facebook, Goldman Sachs. NCR just bought a crypto company called Liberty X. We're talking about the exchanges, Deutsche Börse, NASDAQ. We're talking about the New York Stock Exchange. We're talking about leading financial advisory firms like Fidelity, who are currently applying to set up a Bitcoin ETF. We're talking about technology firms like Ant Financial out of China, companies like Apple with Apple Pay. We didn't mention Starbucks, but Starbucks Pay. Starbucks Pay is a FinTech technology. And then we're talking about the creation of new digital assets, things like central bank digital currencies that will be launched by the Chinese government, the European Central Bank, the United States Central Bank. And then we're talking about the applications, even with traditional companies like Walmart, using FinTech to track the shipment of goods all over the world. Maersk, the largest shipping company in the world. So please keep in mind that when you talk to FinTech people, and when you think about FinTech, it's not crypto. That is a very tiny slice of what we are talking about. And if you remember what Goldman Sachs said, they think blockchain and FinTech could change everything. And going back to the beginning of our presentation, if you think about 50 years ago, the internet was just a glimmer in the eyes of the Defense Department. And you remember that NASDAQ was just getting started. And if you think about it, in the mid-2000s, electronic banking was really starting to hit its stride. If you think about today, the internet is everywhere. It is part of our lives from the moment we wake up to the moment we go to sleep. And if you think about electronic banking and investment advice and electronic trading, it's everywhere. So we are now open to questions. I don't know, Claire, do we have any questions that have come in from the audience?
We've got a few here, Rick. One person wanted to know, what is